Hey, quick question. What's your money doing right now? Sitting in your wallet? Hanging out in your bank account? Earning next to nothing? What if I told you it could do so much more, like grow, multiply, and help you achieve your biggest goals? Welcome back to Stock Market Stories, where we simplify the world of investing, one story at a time. Today, we're starting at square one, how you can go from zero to investor in the stock market. Are you curious but overwhelmed? Or maybe you think investing is only for the rich or the experts. Spoiler alert, it's not. By the end of this video, you'll see just how easy and accessible it can be. Grab a notebook and let's dive in. Let's start with the big question. Why should you invest in the stock market? Simply put, it's one of the most effective ways to grow your money over time. By investing, you can beat inflation, build wealth, and achieve life-changing goals. Whether that's retiring comfortably, buying your dream home, or funding the adventures you've always dreamed of. Here's some perspective. Historically, the stock market has delivered average annual returns of 7 to 10% after inflation. While that might not sound flashy, those returns add up significantly over time. It's a compound effect, where growth builds upon growth, and that's what makes the stock market such a powerful wealth-building tool. The key is staying invested despite the inevitable ups and downs. Markets can be unpredictable in the short term, but over the long run, patience pays off. Think of it this way: investing isn't about getting rich overnight. It's like planting a seed. You water it consistently, give it sunlight, and over the years, it grows into a sturdy tree. The longer you allow your investments to grow, the stronger and more fruitful they become. Investing is your chance to take control of your financial future. Unlike a savings account, where your money sits passively, investing actively puts your dollars to work, multiplying their potential. By starting now and staying consistent, you're equipping yourself with a powerful tool to build the life you want. But remember, it's a marathon, not a sprint. There's no need to rush or chase quick wins. The sooner you start, the more time your money has to grow, and time is the one resource you can't get back. Start small, stay disciplined, and let the magic of long-term investing work for you. Before diving into the stock market, it's important to understand a few key terms. First, what is a stock? A stock is essentially a small piece of a company that you can own. When you buy a stock, you become a shareholder, meaning you own a tiny part of that business. Pretty cool, right? Now, as you buy stocks, you'll build what's called a portfolio. A portfolio is simply a collection of all the investments you own. Next, let's talk about diversification. Think of this as your safety net. Diversification means spreading your money across different investments to reduce risk. It's the classic, don't put all your eggs in one basket strategy. Instead of investing everything in a single stock, you might spread your investments across stocks, bonds, mutual funds, and ETFs. This way, even if one investment underperforms, others can balance it out, helping to protect your overall portfolio. Another essential concept is risk tolerance. This is all about how much uncertainty you're comfortable with. Are you okay with short-term losses if it means the potential for higher long-term gains? Or do you prefer steady, more predictable growth? Your financial goals, timeline, and personality will determine your risk tolerance. For example, if you're saving for retirement decades away, you might be more comfortable with higher risk investments than if you're saving for a house in a few years. Understanding these basics, stocks, portfolios, diversification, and risk tolerance sets the foundation for making smart investment decisions. Once you have a clear grasp of these concepts, you'll feel much more confident navigating the world of investing and building a portfolio that works for you. So, for the main part, here's your step-by-step roadmap to start investing in the stock market today. Why are you investing? Your goals will shape your strategy. Are you saving for something short-term, like buying a car in the next 5 years? Or are your goals more long-term, like retiring comfortably in 30 years? Defining your timeline helps determine the types of investments that align with your objectives and how much risk you're willing to take. Before jumping into investing, it's crucial to have an emergency fund in place. Aim to save 3 to 6 months' worth of living expenses. This safety net ensures you won't have to sell your investments during unexpected situations like a job loss or an unexpected medical bill. Think of it as your financial cushion. Next, you'll need a brokerage account to start buying and selling stocks. Look for platforms with low fees, user-friendly apps, and plenty of educational tools to guide beginners. Some popular options even allow you to start with very small amounts, making it easy to dip your toes in the market. Index funds and ETFs are ideal for beginners. They provide instant diversification by bundling multiple stocks into a single investment. For example, an S&P 500 index fund gives you exposure to 500 of the largest US companies, spreading your risk while offering steady growth potential. Plus, these funds typically have lower fees compared to actively managed options. You don't need a fortune to start investing. Even $50 a month can grow into something substantial over time. Automate your contributions to stay consistent and let your investments work for you in the background. Consistency is the key to long-term success. Now, let's talk about some common mistakes that can trip up new investors. Avoiding these pitfalls will save you a lot of stress and help you stay on track. First, don't chase hot stocks just because they're trending or someone claims they'll make you rich overnight. Investing based on hype is risky and often leads to disappointment. Instead, focus on building a diversified portfolio with investments that align with your goals and risk tolerance. Second, don't panic sell when the market dips. Market fluctuations are normal, and selling in a panic locks in your losses. Remember, the stock market rewards patience. It's better to stick to your strategy and ride out the ups and downs. Historically, the market has always recovered over time. Third, avoid over-concentrating your investments in a single stock or sector. It might feel tempting to put all your money into one sure thing, but this can backfire. Diversification, spreading your investments across different companies and industries, is key to managing risk and protecting your portfolio. Lastly, don't let your emotions drive your decisions. Fear and greed are two of the biggest enemies of successful investing. Instead of reacting to short-term market movements, stay focused on your long-term goals and stick to your plan. By avoiding these rookie mistakes, chasing trends, panic selling, over-concentrating, and letting emotions take over, you'll set yourself up for a smoother investing journey. Remember, the goal is steady progress, not perfection. Let's wrap up with one of the most powerful concepts in investing: compounding. This is the magic where your earnings generate even more earnings. It's like a snowball rolling down a hill. It starts small but grows bigger and faster as it gains momentum. The earlier you start, the more time compounding has to work its magic. Here's an example to show just how powerful this is. Let's think you invest $1,000 at age 20, and it grows at an average annual return of 7%. By the time you're 60, that $1,000 could grow to nearly $19,000. But if you wait until age 30 to invest the same $1,000, it only grows to about $10,000 by age 60. That's almost half the potential growth, just because you started 10 years later. Time is your best friend when it comes to investing. The earlier you start, the more years your investments have to grow and multiply. Even small contributions made consistently over a long period can lead to impressive results. It's not about how much you start with, but how early and consistently you invest. The key takeaway here? Start as soon as you can. Even if you can only invest a small amount, it's better to begin now than to wait for the perfect time. Compounding rewards those who think long-term, stay consistent, and give their money the time it needs to grow. So, remember, start early, think long-term, and let the power of compounding turn your financial goals into reality. And there you have it, your ultimate beginner's guide to the stock market. Remember, investing is a journey. Start small, stay consistent, and let time do the heavy lifting. If this video sparked your confidence to take that first step, great! And if you're still figuring it out, that's okay too. Every journey starts with curiosity. Just keep learning, keep growing. If you found this helpful, don't forget to like, subscribe, and hit the bell for more tips to grow your financial future. Thanks for watching, and see you in the next video.